Good day traders, Stacey Burke from Stacey Burke Trading. Today we're going to be reviewing the opening range on my end of day trading setups and how I look at the end of day market. One of the ways I look at it, but today I'm going to review the opening range, which for me is the Monday. End of day, one of the main reasons I like end of day trading is that my goal is to be off the screen. Primarily because most of my mistakes in trading always occur when I try to trade on the shorter time frames, on the hourly or 5-minute trading systems, which even though there are some fantastic opportunities, my goals have always been to hopefully move in a direction of mastering the end of day time frame trading, because I feel that that's where the greatest opportunities for the asymmetrical risk reward setups are. And also just again for myself, my I guess track record has not been the best on consistency, but also most of the mistakes that I've made, averaging into losing trades, moving my stops, not having a stop, taking too much leverage, counter trend trading because I'm on too short of a time frame. They've all occurred when I've day traded the market. So the bulk of my trading has been moving towards end of day, and as I said earlier, my goal is to pretty much only do end of day trading at this time. Now that said, I have taken some hourly trades in the last week. They were, I think, good setups. And we'll talk about that as well, because there are some fantastic opportunities. But one of the things about trading on the hourly time frame, even if you want to try and trade, Asia close, London open, New York open, is that you still have to be at the screen, and that considerably, day in and day out, you may not get things happening exactly at the same time every day. You might want to trade London open, and it might not give you the right setup until 3 hours into the session. So again, with end of day trading, as you'll see here, my approach is pretty simple. There's a few other things but just in keeping with just looking at things in a step-by-step process, one of the things that I look at are the market opens. A lot of the stuff that I got from end of day trading came from studying market profile, Dalton's book, Stottlemyre. There's lots of different ways to trade. I'm not saying that my way is the right way or anything else. It's just the way that I approach the market, and I feel that the market generates information that we can use week in and week out pretty much consistently on any currency pair to give us a high possibility, low risk trade setup. So today I'm just going to be reviewing the opening range. So for me, the opening range is the Monday bar. One of the things that Dalton talks about is the opening price, and there's a couple of key things that he talks about, and one is that is the market, where is the market opening in relation to the previous time frame. So in this particular case, we're going to be looking at the previous week. So for example, this week, if we look at Monday's price action, I'm going to use some horizontal red bars to look at the range. So if we look at last week's price range, there's last week's high, and if we look at the last Monday's high, you can see that the market initially traded, it had a range. Monday's high and low were the range, and we talk about the initial balance, which is the first two time frames. So if we were applying that to end of day, we'd be looking at the Monday, Tuesday, and in this particular case, because the market has given us a tail and then come back into range, I would use Monday's range just in relation to this week as our point of reference. So again, last week we see the Monday trade. It gives us an idea of the opening range. Then we get a range extension. The market comes back inside. It closes inside of the range. Gives us a pin bar on the Wednesday. Pin bar traders would have taken the long on the break of Wednesday's high. And as we see, what we look for now is where is the market opening in relation to the previous week? Is it in range? Yes, it is. Is it in value? Well, in the value area, it's a little harder to apply on end of day, but you can see where last week the bulk of the trading towards the end of the week was in that upper half of the week's range. So you could say that it was relative to pretty much in that value area, but it's also in balance. So it's staying inside of the previous day's candle. Now, one of the other questions we will ask is, was there any direction of inventory in the close of the last period? So Wednesday, Thursday, Friday, the market was moving up. And two of the questions that Dalton will often ask is, which way is the market trying to go? And how good of a job is it doing that? So if we were to apply that to, we have our Monday trade. So if we're looking at this on Tuesday morning, which would be, if you're in North America, that would be Monday evening. So the Asia Open is Monday evening in North America. It's Monday morning in Perth, Western Australia. So we look at this and we say, yes, we're in value. So at this particular point, we have a couple of things. We have the market breaking out of its range for the second week in a row. Its inventory has appeared to be moving upwards. We have a bear candle on the Monday, but it's inside of range and inside of value. And if we apply our opening range principles to this, breakout traders have an opportunity. So if we just go back and we'll clear this. If we now look at this as there's our range, we're in the same range as the previous week. The market has broken out from the previous week's range on the Monday. It's managed to stay out. Now on the Monday, it's gave a pullback. Oops, let me just move that over again. So we've had the pullback, and again, we know that if that's the upper side of the profile, that's the lower side of the profile, and this roughly is our point of control, that we have an opportunity to position ourselves on a breakout trade with a lower risk of at least 2 to 1. So if we do the math and we measure the range on the Monday candle and we project that upwards, we know we're going to have at least 2 to 1 to the previous week's top of the profile. So again, just using that, our 2 to 1 brings us just above the previous week's high. Now, one of the things about the initial balance is that in a large majority of the cases, the Monday or the Tuesday potentially may act as a high or a low for that session. So I talk about this with the London and Asia close, often between 2 a.m. and 5 a.m. New York. You'll see a high or a low for the session possibly develop, and that's a great insight for traders if there's been a breakout that's maintained itself for either A, measured move, B, a retracement of that same range, or C, just a range-bound market. So when we apply that to the end of day, again, we're looking for areas where we can position ourselves at one end of a profile, I guess, or a rectangle, where we have at least a 2 to 1, 3 to 1, or more opportunity for a measured move. So take this. Today, again, we're just talking about the opening range. And I'm just going to clear this, and I'm going to just go back and we'll apply this on just any week. So if we take these candles and we move them across on the highs and the lows of the Monday, so again, you can do this on your own time, on your own charts. I'm trying to give you a couple of things that you can start to look for. Now, so in this particular week, we see the high and the low. The inventory was down. Smart traders would have saw this as an H1 pattern that Al Brooks talks about. They would have sold 1 pip above Monday's high. They would have placed their stop most likely above this candle, or a identical range perhaps of the Monday projected north. So they would have, again, may be taking a trade 1 pip above Monday's bar, place or stop 1 bar's distance equal to that again, and looking for at least a 2-to-1 risk reward on that setup. So if that particular Monday was roughly 60, 70 pips, from the low of Monday, we're looking at 508 roughly in that area. So yeah, close to 60 pips. So my point again is just if we look at this and we look at the Monday, Tuesday, we see that we had a range extension and then a market that has gone out of balance and then it's returned in. But that initial move down, traders had the opportunity for a low risk trade. And again, these trades, if they're right, well, they'll be right away. And you can see that the market took breakout traders long, bear traders in short. It closed back inside a range and then moved to the other side to take out the previous week's lows, and then also just beyond that for probably a 1.5 extension of that range. So we go to the following week. Just move these across. We go to the Monday high, Monday low. Now, question again, we have a market that's opened in range, in the previous week's range. Now, these are really important when you get a second week in a row where the market stays in range. There's a high possibility that we will see a move on that particular second week. It's not often that the market will stay range bound for more than a couple of weeks. Now we can see a market stay range bound for a month, but usually we'll see that sort of maybe 2 ATR of a monthly range. So that's usually when we have a rectangle forming. If you look at the longer time frames, you'll see a rectangle forming. And again, if there's a breakout from that rectangle, you're looking at potentially a very large measured move. But point being today, if you're using Monday's opening range, you can start to see that traders that got stuck somewhere here in the middle were just stuck in a range-bound market. Now, what's also important about this particular week is that we also had another opening range for the first day of the month. Now, this particular large candle was the Italian referendum for staying in the European Union. So again, traders, there's been 3 very significant events this year that really impacted markets in a big way. Obviously, Brexit, the Trump election vote, and then this not so much, but still again you can see that's twice, maybe 2.5 times the normal range of a daily candle. So traders who were uncertain, this is the euro was obviously going to be impacted by that. Traders may have stayed aside. That was a Monday again, so traders, look, if you think about things in simple terms, when we apply this information, we're talking about time price opportunities. So if you work at the bank or you're working at a currency trading desk, you come to work on Monday. The market's open Monday. They trade 24/5 until Friday evenings close, Saturday morning in Perth. And then they close and they go home for the weekend. So they're most likely closing positions, and we'll talk about the weekend effect also, where when you see a strong movement on a Friday closing strongly out of balance or in trend for second or third day in a row, most likely you'll see that move continue at least into Monday and possibly into Tuesday. So again, point being here, we see Monday's range was maintained, and we go to the following Monday. Now we see this, and again, people have said to me, okay, that's great, you see Monday's range, but what does that have to do with trading? Well, what we're looking for, number one, is we're looking for indications of a market running out of steam or being at excess. So, again, traders who wanted to short somewhere up high in that range possibly would have shorted the break of Wednesday's low. Some of the traders may have put a limit order up top and done a half ATR of Monday or an average 1 ATR stop of that high. There's lots of different ways to do that. Now, I like to trade the breaks of these lows when we're up high because, again, often the market will run up, trap traders up here, and then reverse and take out that low. But also, again, if I'm taking out down here, unless it's early in the session and we know that there's going to be a news announcement, I'd be leery of getting in unless we know that the market is gone sideways. So if my order hasn't been hit on an inside bar, early in the session, I just sometimes we'll see these fakey patterns run both ends on a major release. But again, you have to test these out, and you have to also have a remove analysis process. So if your plan is that you're going to trade the breaks of these lows, then you just have to trade it. There's your stop. You can place your stop above the high of this candle if you're concerned about that. And indeed, this candle did not. It ran the high first and then ran the low. But again, just looking at the opening range, we see that even if you stayed out of the market, I can't remember what happened on this day. There was obviously some volatility. But if you were out of the market, again, there's an opportunity to position yourself. Traders will often get scared by this big candle, but again, if you're trading on percentage risk, again, every trade is just another trade. It's your perception that it has a greater risk or fear of failing or anything else. So if you're trading 1% risk or 2% risk, there's your stop. Your percentage of risk is the same. And again, when you take that trade, okay, so if that's your risk, what's your projected measurement of at least 1-to-1? Okay, so your projected measurement was down here. We see the market running out of steam down here. And again, traders who are short, when we come to this Monday and we have our opening range, and we put this, sorry about that, we'll just see if we can get this right. We put our high and low on the Monday for that week. Traders may be looking at some point when we see the market starting to go sideways, you're going to at least move your stop down. If you're trading, again, trying to get to that failure low, we have a 20-period lowest close that's actually been closed out above here. There's an opportunity to exit, so a 20-period closing low where the market takes out that high. Again, you'd want to be trailing that down as low as you can because nothing's guaranteed. There's no certainties. There's only possibilities. So again, looking at our Monday high and low, our opening range, we have a market that it opens in range, in value, goes out of balance on the Tuesday and is immediately rejected. Now, we have traders who will position themselves at the market on the breakout, and their first point of stop is going to be the high of Monday, which we see it spikes at. In this particular case, because they've traded counter trend to that strong downward inventory, you can expect a second retest of that low, which we did see. So get in the habit of just drawing your opening range on the Monday. Looking at how is that opening up compared to the previous week. Okay, if it's in value or it's in range, okay, so we have a Monday here. The market has opened up within the same range as last week. It's in the value area. Okay, the value area being where the bulk of the trading has taken place in the last time frame. So the inventory was up. So we'd be looking to possibly get bullish. Now, here's an example of where taking a trade flies into the face of the greatest amount of fear. We see the market break out from the initial balance. It tests the low where breakout traders have gone long the previous week, but it's closed back inside of the range. It's protected that 20-period closing low high. So if you were using that still as your reference point stop, traders may have been game enough to get in long. If they didn't and they got in long up here on the Thursday or Friday morning, again, there's momentum there. And with any of this, especially onto a Friday, if you're trading Monday to Friday, there's your measured move. If you're going to go into a market, set a target on a Friday. Fridays are notorious for reversing. So you're long, again, your risk is the same. To me, that's the safe trade. This one is not. It's with experience, you'll start to maybe see these opportunities. But again, the momentum that carried this through, it didn't take out the high. It's allowed traders to position themselves on Friday morning to really run that and build up momentum. And again, measured move, but also a gap being filled. So these are all the simple things to just start going through, but the simplest thing is to start drawing Monday's high and low, opening range. Let's just take a quick look at the Japanese yen. It's right here. Last few weeks, again, we look at, I'll just project that right through, Monday's high and low. Okay, so we see a very narrow range. That's also a possible indication that the market's getting ready to move. We see the market initial balance stays inside of Monday's range. We get a couple of range extensions, but it stays inside of Monday's range. Breakout traders after Wednesday's bar. So we come back into range. Traders think that the market is possibly going to retest the low from the previous week. They trade the breakout, again a 1-to-1 measured move. Relatively low risk, strong possibility of that market continuing down. We saw the order flow was down the previous 2 weeks, and then we go into the next week. Whenever you're into one of these trades and it's not crystal clear, the first thing you should be looking at is a measured move of the candle that you've got in on. And you got to be going to break even when the market takes out that exact distance, because if there's one more day of trading and the market it's a Friday, again, you can either get out at the low if the market hasn't reversed and it's stayed in the direction that you're trading, or the high, but be prepared on a Friday for that market to possibly reverse and change directions. So we go to the next Monday, Monday's high and low again, opening range, 2 days, initial balance, pin bar. We're at the top of the range from the previous week. So again, start conceptualizing these profiles in your mind. We've got a bracket high and a bracket low. The market forms a pin bar. Breakout traders are taken in on the Wednesday. Thursday morning traders have another opportunity to enter into the market, and we see the market move aggressively down to take out the lows from the bracket from the previous week. So again, another example where the market hits Thursday's low and reverses on the Friday, fills the breakout gap, and then on the following Monday, again, we go through this. And again, I'm just reinforcing to you, looking at Monday's high and low as your opening range, and using that as a tool, market-generated information that you can possibly use to give you a bit more confidence in which direction you should be trading. So we have the breakout gap. The market's filled that. It's opened up on the Monday in range, in value. But now that we have a breakout, we see this now as a point of control. So the previous week's bracket was taken out. We now have formed a new bracket low and a new bracket high once Monday trades. So we have Monday's opening range. Breakout traders are trapped on the Tuesday. Now, this is a great setup because it hasn't taken out the previous week's low. If traders didn't trade the break on the Tuesday, they have an option to place a limit order on Monday's low. If they do nothing on the Wednesday and they wait, now on Thursday, they have an opportunity again where the market has given us a range extension. Remember, one of our golden rules is that 80% of the time, you can go and check, do your own research and study this, but the market has a high possibility of forming a higher or low within the first 2 trading sessions. And if you go back and look at all these Monday, Tuesdays, you're going to see that that is very, very consistent. So if you look at this Wednesday's trade, again, we see a market breakout on the Tuesday, very subtly, but it breaks out of balance on the Tuesday, closes back in range on the Wednesday, but it forms an outside day. Traders can feel confident to position themselves somewhere in this within this candle. Now, there's a couple of ways to look at this, and personally, I look at it like this. I position myself within this candle. So when the market pulls back in, we're already out of balance. If we're going to go short here, I'm going to position myself within this candle and place my stop above that high. So traders, start using Monday's opening range. Look for these subtle clues. Look for these bracket extremes to be hit. Look for opportunities of where markets go out of balance and then back into range, as we see this week. Traders may see something setting up as we talk now, as we know that the market has broken out from the previous Tuesday. So we've got a point of control there. And we also have now just seen Tuesday's market close above Monday's high on the Japanese yen. So I'm looking that it will most likely retest the low at 15.95, which is 100 pips away, and we'll see what happens. Hopefully you got some value out of today's video, traders. Look at the opening range, look at the initial balance, compare that to the previous week's range. Ask yourself two questions. Where is the market trying to go, and how good of a job is it doing at trying to do that? So use the previous session's inventory flow as an indicator. Monday's opening range can give you some very, very high possibility indications of where the market's going to be moving to next. Always manage the downside. Stay disciplined, stay focused. Make the rest of your trading the best you're trading, and may the markets go with you. Have a great trading week. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.